Hello everyone. Today I'm going to go over how to prepare the T accounts. So how to take your business transactions and put them into the T account. So it's just like recording in a general journal. You have a debit and a credit. So on the T accounts, just how they're set up, the title is always at the top. Your debits are always on the left side of the T account. Your credits are always on the right side of the T account. So how to record those transactions, you need to know how each type of account behaves with a debit versus a credit. So your assets, all debits will increase asset accounts and all credits will decrease account. So if you have, for instance, your cash account is a type of an asset account. If cash is coming into the business, that is increasing the cash account, so you would debit it. If cash is going out of the business, you would credit it because a credit reduces the cash account. So you have to know how a debits and credits behave for what particular type of account you're affecting. So if you're looking at accounts payable is a type of a liability account. So all credits increase liability accounts and all debits decrease them. So if you're increasing a liability, so increasing the amount a business owes someone else, you would credit the accounts payable. If you're decreasing a liability, you would debit the accounts payable. So you need to look up how each particular account is affected by a debit versus a credit, and then you will know how to record the business transaction. So let's go through a few of these so I can give you guys an example of the types of things you would see that would actually increase or decrease a particular account. So let's go through this example that I have here. So Oscar Mayer is an attorney. He organized Meyer Law on January 1st, 2022. During the month of January, Meyer Law completed the following transactions. So I went ahead and I put the different letters corresponding to these transactions in here just for a little bit of ease for demonstration purposes. I'll go ahead and put the amounts in here as we're going through each particular transaction. But you can see, where you need to fit in these transactions if you're going through this and working through this on your own. So in part A, he transferred cash from a personal bank account to an account to be used for the business in exchange for common stock of $65,000. So we're looking at this for recording purposes from the standpoint of the business, so from Meyer Law. So Meyer Law received $65,000 in cash. So anytime you're going through a transaction, you want to think about, and you're recording these, you want to think about three basic rules. So your three rules are: you need to have at least one debit and at least one credit for every single transaction. The second rule is you want to make sure you're hitting at least two different accounts, because if I debited cash and also credited cash at the same time for $65,000, it would just zero it out. There's no reason to do that. So make sure you're hitting at least two separate accounts. And then your amounts need to balance. So your debits need to equal your credits. So for here, our $65,000 debit would also equal our $65,000 credit. So let's go through the example so you can see how that's going to be recorded. So my two accounts that are hit here are going to be cash and common stock, because the business received cash, but they also issued common stock to their stockholder of Oscar Mayer. So I have it over here. A debit is going to increase cash. So debits are on the left side of the T accounts and the credits are on the right side of the T accounts. So I'm going to put my $65,000 that the business received in the debit side of the T account. So I have a balance for the top two accounts here just so you can see how it updates as I'm entering this in. I didn't put a balance for every account on here, but I just wanted to do it for illustration purposes for these top two accounts. So cash has the most transactions typically in it, so I definitely wanted to show you how the balance is calculated there. Okay. So my second thing here is I need to hit common stock. So a common stock would be a credit, because common stock is an equity account. To increase an equity account, you would credit it. Okay, so if I go back through my rules, do I have at least one debit and at least one credit? I do. I have a debit here and a credit here. It's two different accounts. I'm hitting cash and common stock, and the amounts balance. My debits equal my credits. So it doesn't mean you're absolutely correct if you have hit those three rules, but it gives you a good indication that you are on the right track. So that's just three things to ask yourself anytime you're recording a business transaction. All right, for part B, they purchased a used automobile for $19,000, paying $7,000 in cash and giving a notes payable for the remainder. So we have 3 accounts being affected here because we received an automobile. So that is an asset. And if you remember, to increase an asset, you debit it. So let's go ahead and record that. I always record what I know first, and then you can fill in the rest later. So an automobile was received, and anytime you're recording an asset on your books, you always want to do it at what it cost you. Doesn't matter if the vehicle is worth $30,000, whatever you paid for it is what you're going to record it at. So we're going to record it at $19,000. We had a couple different things going on here. So we paid $7,000 in cash and we gave a notes payable for the remainder. A notes payable is a type of loan. So I gave $7,000 in cash and then I took out a loan for the remainder. So the remainder would be $12,000 because it has to equal the $19,000 value. So $7,000 in cash is going to be reducing our cash account. And to reduce an asset account, you're going to credit it. So I'm going to go ahead and put that up here. I'm going to put that $7,000 up here. And then we need to know that we need to record a notes payable for the $12,000 remainder. So notes payable is a type of liability account because it's something that the business owes. So I'm going to go ahead and put my $12,000 remainder up here. And then again, I want to go back through my rules. Do I have at least 1 debit and at least 1 credit? I do. I have 1 debit and I have 2 credits for transaction B. Are they 2 different accounts? At least 2 different accounts, I should say. Yes, because I have automobile, cash, and notes payable. And do they balance? So in this case, this is what's going to tell you because we have a $19,000 debit, we have a $7,000 credit, and also a $12,000 credit. So my 12 plus 7 does equal 19,000, so I do balance. So I have at least 1 debit, at least 1 credit, and they balance. All right, part C, paid January rent for office and workroom of $4,400. So they're paying out cash. So that's going to be my credit here. So I have that taken care of. What I need to figure out is what's going to be my debit. So let's go through my accounts here, and you can see rent expense over here. Rent expense is describing what's going on here. So I paid January rent for office and workroom. For an expense account, to increase an expense account, you're going to debit it. To decrease an expense account, you would credit it. Because I'm incurring this expense, my expenses are increasing, I would credit it here. So I'm going to put my $4,400 here, and then I paid out cash, so I need to reduce my cash account. Again, to reduce an asset account, you want to credit it. All right, so I have at least 1 debit, at least 1 credit, 2 different accounts, and they balance. In part D, paid cash for supplies of $4,000. So the business is receiving an asset in the form of supplies. So I want to go ahead and record that. Anytime you're increasing an asset account, you want to debit it. And then they paid cash for supplies. So go ahead and decrease your cash account by the $4,000. All right, so if you went back through your rules, we noticed that we hit all those markers. All right, in part E, we purchased office and computer equipment on account for $9,000. So office and computer equipment is an asset. So to increase an asset, which you did because you purchased the asset, you're going to debit it. So I'm going to go ahead and throw that in my office equipment for $9,000. So this is a little bit different. We purchased equipment on account, which means we did not pay cash for it. We took out a type of a loan, essentially. So it's a short-term loan. Anytime there is a short-term liability, it's going to be something called accounts payable. It's something that's typically due in like 30, 60, or 90 days. So we made an arrangement with whatever company we're purchasing the office equipment from, and they said that you can pay in 30, 60, or 90 days. It doesn't specify on this. But anytime it's a short-term liability, that's called accounts payable. So you can see our accounts payable. To increase a liability, again, you want to credit the account. So we're going to go ahead and say that we incurred that loan. We want to put it on our books showing that we owe that money. Go back, I have at least 1 debit, at least 1 credit. They are 2 different accounts and they balance. All right, in part F, you paid cash for annual insurance policies on automobile and equipment of $4,000. So I'm prepaying for the whole year. That is something that has value to your company. So you haven't used any of that insurance yet because none of the insurance has expired. You haven't even used a month's worth. So it's an asset to the company, not an expense. It cannot become an expense until it gets used. So as you start to use that insurance policy over the course of the year, you're going to move it from the asset to the expense account. But for right now, we're just recording our prepaid insurance. So prepaid insurance, like I said, is a type of an asset because it has value to the company. So in order to increase an asset, you would debit it. So we're going to go ahead and put the $4,000 of prepaid insurance here. We paid it with cash. So to reduce your cash account, you're going to credit it. All right, so I balance here. I have two different accounts and I have at least one debit and at least one credit. All right, part G, received cash from a client for estate work. So they performed legal work, essentially. And so they're receiving cash for the services that were performed. So the type of services that were performed for service businesses are typically titled fees earned. It is a revenue account. So your revenue accounts, in order to increase a revenue account, you credit it. So we're going to go ahead and put that in here because that's what we know. So $12,000 is going to go into revenue. So I need a credit for this. Let's see what it says. They received cash, so that's easy. Our cash account went up by $12,000. So I'm going to go ahead and put that up here. So I have at least one debit, at least one credit, and they balance. So I received cash for work that was performed. All right. Part H, paid cash to creditors on account. So we had that accounts payable, remember, down here for $9,000. We're starting to pay that back. So in order to reduce a liability, you debit it. So I'm going to go ahead and reduce my liability by $2,570. And then I paid cash. So I paid cash of $2,570 to reduce my cash account. I would credit it. So if I wanted to find the balance to see how much I still owed on this particular account. So each type of account has a normal balance side. Whatever the positive side of that particular account is its normal balance side. So an asset account, its normal balance is going to be on the debit side. A liability account, its normal balance will be on the credit side because that is the positive side. Accounts payable, liability, again, will be on the credit side. Equity is it's not a liability, it's an equity account, but it also has a positive side on the credit side. Fees earned, same way, because you increase a fees earned with a credit. Expenses are all increased with debit, so they have a normal balance on the debit side. So when I'm going to calculate this, I owed $9,000 originally. I have paid back $2,570 to figure out your balance. You just take $9,000 minus the $2,570 because this is the positive side, this is the negative side. So go back, and if it's a little confusing at this stage, review the rules for debits and credits, and it should hopefully make it a little more clear to you. All right, part I, we paid cash for miscellaneous expenses of $375. So anytime we're paying out cash, we're going to credit it. So I'm going to put that in here since I know that. And then I have a title called miscellaneous expense. To increase my expenses because I've incurred that, I'm going to go ahead and debit it because you increase an expense account by debiting it. All right. And then J, recorded fees on trust work, payment to be received in May. It was $8,000 worth of work. Anytime you've actually performed the work, you can go ahead and record fees earned because you have earned it. So revenue cannot be recorded until it has actually been earned, which means the work has been completed or the products have been delivered. So we're going to go ahead and record fees earned of $8,000. Again, fees earned is a revenue account. To increase a revenue account, you will credit it. We didn't get paid, however. They're not going to pay us until May. We made arrangements with them. We said that we've performed the work now, but you have until May to pay us. So that is considered an accounts receivable. It is an asset to you because it has something of value. Somebody owes you money now. So you have to go ahead and record it in your books. And in order to increase an asset account, you would debit it. So again, accounts receivable is an asset account. It is something that is owed to you. So you have performed work, you have provided a product. but somebody hasn't paid you yet. So that means some money is owed to you. So if we go back through our rules, we have at least one debit, at least one credit, two different accounts, and they balance. So 8,000 equals 8,000. All right, in part K, we paid installment due on notes payable. So we have this notes payable over here of $12,000. We paid part of it. So that would actually reduce our notes payable amount. To reduce the liability account, you debit it. So I'm going to go ahead and put it on the debit side. And I paid it out in cash. So that would be my $350 here. All right. So you notice as I've been putting this in, it's been updating the balance here on the cash account. It's an easy way to do that if you want to see how I did that. So I would just summed up this side and summed up this side and subtracted them. So again, cash account is an asset account. It has a normal debit balance, so its balance will always be on the positive side, at least for accounting class. We know that sometimes the cash account does go negative, but most of the time, hopefully it'll be on the positive side. So your balance, it has a debit balance of 54,305, which is essentially the sum of the debits minus the sum of the credits. So our notes payable updated automatically over here because I had my formula in here. So notes payable has a normal credit balance. So we started off with 12,000. We paid $350 on it, so we still owe $11,650. So each of these accounts would typically be updating the balance as it goes throughout the month and the year, so that at any given time, anytime you're recording these transactions, you can see the balance. That's especially important in the cash account because a business needs to know how much cash they have on hand at any given time. So every time a journal entry is recorded, the balance is automatically updated so that they know their cash balance at any given time during the month. Okay, so that does it for recording in the T accounts. I hope you guys have fun practicing with these. It's nice to set up your own T accounts in Excel and play around with it a little bit as you're going through any problems that you see in your accounting course. This is typically around like the second chapter of a typical financial accounting course. So this is a corporate accounting and financial accounting. So if you are in a course that is working with sole proprietorships, your accounts, your equity accounts would typically look a little bit different. So make sure to pay attention to what textbook your professor is using. So again, this is for a corporate financial accounting course. So I hope you all have fun playing with this and setting up your own Excel spreadsheets, and good luck with everything.